Joining us now to talk about what's at stake, Kathryn Thompson, Thompson Research Group CEO. I imagine that this would be extremely disruptive, especially at this time of year.
Yeah, I think the first thing you have to do is, why is there a strike? And so it's the basics, it's pay, healthcare, and a key focus in particular is on automation or really more demands to withhold any type of automation or semi-automation. If you look at just New York, where you guys are, the Port of New York, New Jersey, it's about a third of goods in all of the U.S., and it's a key destination just because of how densely the U.S. population is in that area. Of course, it will be very disruptive. It's one step forward, one step back. You had interest rates were cut, but costs should go up with disruption at the ports. One thing to think about, there's just three buckets. First, you got supply chain, they're going to be disrupted again. You can have some Asian importers that will divert goods to West Coast. You can rail and truck those, but that's going to lead to higher cost overall when you're having more expensive transportation with rails and over the road. And it's just a day-to-day disruption. Some of the typical goods that you would expect to get may be a little bit slower.
The things that you described are like a nightmare for the economy, because you're really talking about it could hurt growth, it could hurt GDP, probably. I don't know what your estimates are for that, depending on how long it went, and it would also increase costs. So that almost sounds like, those are either one is bad. You put them together, and it's a really bad elixir for the economy.
Yeah, not that there's a silver lining, but shippers have been anticipating this. And so typically you have peak shipping by August, but peaked in June, it looks like, based on the flow of goods. Doesn't make it better, but there are just going to be certain things that are going to be much more difficult to ship in advance. So produce would be a really good example. So if you have any type of produce coming from Latin America, that's going to be disrupted. Also, there's going to be certain industries that have more just-in-time nature. Think of the auto industry. That's also going to be a bit more disrupted versus other industries. Will we get all of our Christmas goods? I think that we're well along the way with that, but there's going to be other areas where it's going to be a little bit tighter overall.
What's in your assumption that this definitely happened? And the reason I ask it, it's been a good, there's like a buyer's market or a seller's market. It's been a good time to be on the negotiating side if you're labor at this point. And we saw what happened with the automakers, and we're watching with Boeing. I mean, they are emboldened at this point. Are you pretty certain that this is going to happen, and it will be a long, protracted strike at this point? Is that what Thompson is thinking?
This is one where on labor negotiations, it's very, very tricky to in terms of determining. But in terms of broadly speaking, you are seeing more labor activity. I think this is just a natural extension of what we've seen post-COVID and the stress on labor overall. On the other end, listen, there's going to be some winners and some losers out of all of this. Overall, I think, there will be certain labor concessions that will be met. And so that will be good for workers. But if you look at certain industries, you can have some unlikely winners from all of this. Using cement as a really good example. We're net importers of cement in the U.S. just to meet demand. If you're not importing as much cement, that means domestic producers like CRH, Martin Marietta, Summit Materials, and Cemex will be able to have more supportive pricing in their markets. So it's a little bit of have and have nots. It just depends on kind of the industry and the focus you get into.